Welcome back to the deep dive. Today we're tackling, well, a really crucial stack of standards: IAS 8, IFRS 13, IAS 2, and IAS 41.
That's right. These aren't just numbers and rules.
Mm.
They get to the heart of how companies report consistently and, importantly, how they value things.
Yeah, and we're digging into that fundamental tension,
Yeah.
historical cost versus, well, market reality and maybe even future potential.
Exactly. Think of these as the machinery for comparability.
Mm.
IAS 8 stops companies just changing definitions whenever they feel like it.
Right.
IFRS 13 tries to make fair value mean the same thing everywhere.
Yeah.
And IAS 2 and 41, they draw the line between valuing, say, a box of bolts and a herd of cattle.
It's all about reliable, relevant information, which sometimes means pretty strict rules.
Brutally strict sometimes.
So our mission today zeroes in on that tension, correcting the past versus adjusting for the future, the cautious approach for inventory versus, well, the much more radical fair value for living things. Let's kick off with IAS 8, the rulebook for changes.
Okay, IAS 8. This covers how you choose your accounting policies and then, importantly, how you handle changes to them or fix mistakes.
First up, accounting policies. Sounds dry, but these are the bedrock rules, right? Like how you depreciate assets or recognize revenue.
Precisely. The specific principles, bases, rules an entity applies. And they have to be relevant. They need to matter for decisions and reliable.
Reliable meaning neutral, prudent, complete.
You got it. And normally, you don't change them. Stability is key for comparing results year after year.
But changes happen, a new standard comes out, or maybe there's just a better way to show what's really going on. And this is where IAS 8 makes a huge distinction, isn't it? Policy change versus estimate change.
Absolutely critical difference. A change in policy needs retrospective application.
Retrospective, meaning you go back in time, effectively.
Yes, and that's a heavy lift. If you change a policy, maybe you start capitalizing development costs you used to expense. You have to act as if you always use the new policy.
Which means?
It means restating the opening balance of retained earnings and rewriting the comparative figures for previous years shown in the accounts.
Wow, okay, that sounds disruptive. If I'm an investor and see a company restating the last 2 years because of a policy change, what should I think? Major upheaval. Does it undermine the old numbers?
It can, yeah. It signals the old figures aren't directly comparable to the new ones. It's costly, takes effort, and definitely raises questions. Now, contrast that with a change in accounting estimate.
Which is perspective, only looking forward.
Correct. Estimates are about amounts with inherent uncertainty. Think useful lives of assets, warranty provisions, bad debt allowances, things like that.
So if you decide your trucks will last longer than you first thought,
You just change the depreciation charge from now on. You don't go back and redo the last 5 years. It's pragmatic. It accepts that estimates change as you get new information without messing with the past.
okay, so policy change, retrospective, fundamental shift. Estimate change, perspective, refining judgment. Got it.
Exactly. But then there's the really painful one under IAS 8, prior period errors.
These aren't judgment calls. These are just mistakes.
Right. Mistakes,
Mhm.
calculation errors, misapplying a policy, maybe even fraud. Things that were wrong based on the information available at the time.
So let's say a company finds out, I don't know, $5 million in expenses just weren't recorded 2 years back. A big error. How do you fix that?
That needs the same treatment as a policy change. Retrospective restatement. Full history rewrite.
Ah.
You adjust the opening balances of assets, liabilities, and retained earnings, pretending the error never happened. For an analyst, finding a material prior period error, that's way more concerning than a policy change.
Because it points to weak controls. The past numbers were just wrong.
Precisely. It casts doubt on the reliability of everything previously reported. You're correcting a flawed history.
Okay, so IAS 8 is all about keeping that historical record clean and comparable. Now, let's shift gears. From fixing the past to measuring the present, maybe even the future, how do we get consistent market values? IFRS 13.
All right, IFRS 13. This standard is vital because it gives us one single rulebook for fair value whenever another standard asks for it. It aims to take the guesswork out.
And the interesting thing is, it's not about what we paid or what it would cost us to replace something. It's about the exit price.
That's the absolute key. Fair value is the price you'd receive to sell an asset or pay to transfer a liability. It's an orderly transaction between market participants on the measurement date,
Yeah.
purely market-based.
It assumes the highest and best use by the market, not necessarily how we're using it.
Exactly. But not everything has an easy-to-find price tag, right?
No, definitely not. Which is why the valuation hierarchy in IFRS 13 is so important. It basically tells you how much to trust the number.
Absolutely.
Right.
It ranks the reliability of the inputs used to get to that exit price. Level 1, that's your gold standard. Quoted prices in active markets for identical things. Think shares on the main stock exchange. No adjustments needed. Very objective. Level 2 inputs are still observable, but maybe not perfect matches. Quoted prices for similar assets, or identical ones in markets that aren't very active, often need some tweaking, some adjustment.
Still based on market data, though.
Yes. But then you get to level 3. And this is where, well, analysts really need to pay attention.
This is where the assumptions creep in. Management's view takes over.
Pretty much. Level 3 uses unobservable inputs. Management has to build models, make projections, use their own data because the market isn't giving clear signals. Think complex derivatives, unique private equity stakes, that kind of thing.
So if I'm looking at a company and a big chunk of their assets are valued using level 3 inputs, I should be thinking their value is really sensitive to management's own forecasts, discount rates, cash flow predictions.
You should. It's
Yeah.
management using its best guess, its own crystal ball, if you like. The reliability is inherently lower.
So how does the standard handle that risk?
Through disclosure. Loads of it. If you use level 3, you have to explain your techniques, the inputs, and crucially, the effect of those measurements on profit or loss. Discipline through transparency, basically.
Makes sense. Okay, so we've got rules for changing numbers, IAS 8, rules for market-based measurement, IFRS 13. Now let's swing back towards conservatism, back to basics with IAS 2, inventory.
IAS 2. Yes, this is probably one of the most fundamentally prudent standards out there. It enforces a kind of safety net. The core rule, inventory must be valued at the lower of cost and net realizable value, NRV, always.
Lower of cost and NRV. So you can't overstate the value of stuff you haven't sold yet.
Exactly. It prevents booking profits before they're truly earned from a sale.
And defining cost here is crucial, right? It's not just the supplier's invoice.
Right. Cost includes the purchase price, import duties, transport costs,
Right.
all that, plus costs of conversion.
Conversion costs being direct labor, factory overheads.
Yes, direct labor and production overheads, but only the overheads allocated based on normal capacity levels. You can't inflate inventory costs just because your factory was running inefficiently slow one month.
And what costs are definitely out? What gets expensed immediately?
The standard's very specific. You expense abnormal waste, way more scrap than usual, for instance. Most storage costs are out, unless storage is a necessary production step, like aging whiskey.
Okay.
Admin overheads that don't relate to getting inventory ready, expensed. And critically, all selling and distribution costs. They hit the income statement, not the balance sheet.
That's important. So if, say, a fire damages a load of raw materials, you can't hide that cost in the remaining inventory value.
No, that loss from abnormal waste has to be recognized immediately as an expense.
Yeah.
It forces you to acknowledge production problems or losses quickly.
Okay, that's the cost side. What about the other side of the comparison? Net realizable value, NRV. How does that differ from IFRS 13's fair value?
Good question. NRV is entity-specific. It's your estimated selling price in the normal course of business, less any costs still needed to finish the goods, and less the cost needed to actually make the sale.
So it includes selling costs, which fair value generally doesn't.
Correct. Fair value is a market exit price. NRV is about your expected net cash inflow from selling that specific inventory. So NRV is almost always going to be lower than fair value.
And IAS 2 says use the lower of your cost in this NRV figure, so it constantly forces companies to check if the market has fallen or if their inventory is obsolete and write it down if necessary. Very conservative.
Very. And just quickly, on calculating cost for items you can't tell apart, like bags of flour, you use either FIFO, first in, first out, or weighted average cost. But for unique items, a custom-built machine, maybe you have to track its specific actual cost.
Right, that makes sense. Okay, standard manufactured goods covered. Now for the really different one. The standard that throws conservatism out the window almost and embraces biological change in market prices, IAS 41 agriculture.
Yes, IAS 41, definitely an outlier. It applies to biological assets, living animals, and plants and agricultural produce, but only right at the point of harvest.
And this is where the measurement gets interesting. Unlike IAS 2's lower of, what does IAS 41 say for, say, a herd of dairy cows or a forest plantation?
IAS 41 says measure them at fair value, less estimated point-of-sale costs. And you do this not just when you first acquire them, but at the end of every single reporting period.
Hold on, let me get this straight. A farmer can recognize profit in their income statement just because their sheep got heavier, or the market price for wool went up, even if the sheep is still, being a sheep and hasn't actually been sold or shorn yet.
That is absolutely correct. The gain or loss from that biological transformation, the growth and from market price changes, goes straight to profit or loss.
Wow.
IAS 41 reflects the economic reality that value is being created through growth in biological processes even before a final sale. It's production happening in the field, not just in a factory.
Okay, that must make forecasting tricky with market price swings, but I see the logic. Now, there's a key distinction here, isn't there, between biological assets and bearer plants.
Yes, very important. A bearer plant is a living plant used to produce goods over multiple periods, but the plant itself isn't the main product. Think an apple tree, a tea bush, a grapevine.
So the tree itself?
The tree, or the vine, that's accounted for under IAS 16 property, plant, and equipment. You treat it like machinery, essentially. You depreciate it.
Okay, so the tree is IS 16, but the apple's growing on the tree.
The apples on the tree are the agricultural produce. They fall under IAS 41 at the point of harvest.
Mm.
Same for milk from the cow. Cow is IAS 41, milk is IAS 41 at harvest. Or wool from the sheep. Sheep is IAS 41, wool is IAS 41 at harvest.
And that moment of harvest is the big switchover point.
It's the crucial transition. The agricultural produce, the harvested apples, the milk in the tank, the shorn wool is measured at fair value, less cost to sell at the instant of harvest.
And then what happens to it?
That fair value, less costs to sell figure immediately becomes its cost for the purposes of IS2 inventory.
Ah. So the harvested apples become inventory, subject to the lower of cost, which was set at harvest, and NRV rule.
Exactly. IAS 41 values the growth up to harvest. IAS 2 takes over afterwards for the harvested product.
Fascinating. We've really covered a huge spectrum today, from IS 8 forcing us to fix the past, to IFRS 13 demanding market prices, then the caution of IS 2 for inventory, and finally the biological reality check of IAS 41.
It really shows that financial reporting isn't just one single approach, does it? You need IAS 8 for consistency, you need IFRS 13 structured way to look at market value, but you also need totally different philosophies for different assets. Prudence for inventory under IAS 2, market value and growth recognition for biological assets under IAS 41.
It really highlights that tension we started with. IAS 8 makes us go back, restate history, be absolutely accurate about the past. But ISS 41 forces us to value living things based on today's market estimates, booking gains before anything's sold. We're demanding historical perfection and immediate recognition of future potential, often based on estimates.
That's the balancing act.
So here's the thought to leave you with. What does it truly mean for the reliability of financial information when the rulebook itself contains these fundamentally opposing pressures? One looking strictly backward to correct, the other looking quite radically forward to value potential right now. That's the complex world investors and analysts navigate every day.